Buffett, Burry, and Saudi Arabia's $1 trillion fund just all bought the same stock. It's not tech, it's not energy, it's a healthcare stock most people weren't even watching until now. United Health Group. So what did they know that you don't?
United
Healthcare.
Berkshire Hathaway has been buying and revealed that they have a position in United Health.
Appaloosa also making a big bet on United Health.
The Big Short's Michael Burry's Scion Fund bought about 370,000 shares, and the Soros Fund chimed in with 100,000 shares.
Buffett bumped today after Berkshire Hathaway and a number of other big-name investors reveal new positions in the insurance giant.
In just weeks, some of the world's most powerful investors have poured billions into this one stock. We're talking Warren Buffett, David Tepper, Renaissance Technologies, and Saudi Arabia's Public Investment Fund. These aren't trend chasers. They're value hunters, data-driven quants, and global strategists. In fact, for Buffett, this was the biggest purchase he has made since 2022. When investors with completely different styles all pile into the same company, it's not random. It's a signal. And the moment those buys went public, the stock jumped 12% almost overnight. So what's behind the sudden rush? Why are these heavyweights betting big on United Health right now? It comes down to three things: price, long-term potential, and timing. United Health Group isn't just another health insurer. It's the biggest in the country, and its footprint stretches across nearly every corner of the healthcare system. It doesn't just sell insurance plans. It runs clinics, manages pharmacy services, handles data analytics, and even delivers care directly to patients at home. Millions of Americans rely on it through programs like Medicare Advantage, and it plays a role in everything from routine doctor visits to prescription refills. That kind of scale makes it hard to ignore, especially when the stock takes a hit and top investors start circling. That's exactly what happened. The buying wave kicked off with Warren Buffett's Berkshire Hathaway making a bold move. They picked up just over 5 million shares, worth about $1.6 billion. The market reacted quickly as United Health stock jumped 12% almost overnight. This kind of play is classic Buffett. He looks for strong companies going through short-term trouble, and United Health fits the bill. The company was reeling from its fair share of problems that we'll dive into later. So when the stock dropped hard, Buffett saw what others missed: a dominant player in a sector that's nearly impossible to break into. Health insurance isn't something startups can just disrupt, and that kind of moat is exactly what Buffett likes. Interestingly, Buffett wasn't the only shark to smell blood in the water. Right behind him came Dodge and Cox, a fund known for its steady hand and long-term focus. They scooped up 4.73 million shares, building a stake worth over $1.4 billion. Dodge and Cox doesn't chase trends. They wait for solid companies to stumble, then step in and hold for years. Their move says they believe United Health's problems are temporary, and its core business is still strong enough to deliver solid returns over time. To see them buy this stock means that they are giving it quite the endorsement of value. David Tepper took things even further. His hedge fund, Appaloosa Management, boosted its stake by a staggering 1,300%, ending up with 2.27 million shares, valued at around $700 million. Tepper is known for going against the grain. He watches the big picture, things like economic shifts, market sentiment, and bets on sectors that others are fleeing. Healthcare stocks have been under pressure, and Tepper clearly thinks the sell-off went too far. By buying this much, it shows that his bet isn't just on United Health recovering, it's on the entire healthcare space bouncing back. Then there's Renaissance Technologies, the quant giant. They don't make moves based on headlines or gut feelings. Their $422 million position in United Health, made up of 1.35 million shares, likely came from their algorithms spotting something in the numbers. Maybe it was a trading pattern, maybe a valuation mismatch, but whatever it was, their models said the stock was ready to climb. When a fund like Renaissance steps in, it's because the data backs it up. Michael Burry, famous for calling the housing crash, took a different route. He bought 20,000 shares outright, but the real bet was in call options tied to 350,000 shares, with a notional value of around $190 million. Options let him control more shares with less cash, and if the stock rises, his gains multiply. Burry tends to move when fear drives prices too low, and his play here suggests he sees a sharp rebound coming. He's not afraid to go against the crowd, and his track record shows he often gets it right. Saudi Arabia's public investment fund even joined the party, using call options to build exposure. With nearly $1 trillion under management, the PIF isn't chasing quick wins. They're looking decades ahead, and healthcare fits their strategy perfectly. As populations age and demand for care grows, companies like United Health are positioned to benefit. Their move adds an international layer to the story, showing that confidence in United Health isn't just local, it's global. So when you look at the lineup made up of Buffett, Dodge and Cox, Tepper, Renaissance, Burry, and the PIF, it's clear this isn't random. These investors saw past the noise and focused on the fundamentals. United Health may have stumbled, but its core business, scale, and long-term potential are still intact. That's why the smart money moved in, and it's what kicked off this wave of buying. When you really do look at the situation, you quickly realize that United Health's rebound didn't come out of nowhere. The stock's steep decline of nearly 46% year-to-date before the rally was one of the sharpest in its history. That kind of drop doesn't just shake confidence, it forces investors to reevaluate everything. But instead of running for the exits, some of the most respected names in finance saw something different. They saw a moment where price disconnected from reality, and that's where opportunity lives. What made this moment stand out wasn't just the size of the drop, it was the setup behind it. United Health's valuation had compressed to levels not seen in years. Its forward price-to-earnings ratio fell to 16.45, well below its usual range of 18 to 20. For a company leading one of the most stable sectors in the economy, that's rare. It signaled that the market was pricing in more fear than fact. And when that happens, investors who focus on long-term fundamentals start paying attention. But valuation alone doesn't drive conviction. What really matters is what's underneath the surface. United Health's business model is built on consistency. It generates strong cash flow, maintains healthy margins, and operates in a space where demand doesn't fluctuate wildly. That's why the dividend became such a focal point. As the stock fell, the yield climbed above 3%, offering investors a steady return while they waited for recovery. The company reaffirmed its quarterly payout of $2.21 per share, totaling $8.84 annually. With $10 billion in free cash flow last quarter, that dividend isn't just sustainable, but it's backed by real earnings power. This kind of setup, low valuation, strong cash flow, and a rising yield, is what value investors call a margin of safety. It's not just about upside potential, it's about limiting downside risk. And when you combine that with a business that's proven it can weather storms, the case becomes hard to ignore. So the big question that is probably going through your head right now is, if United Health is such a powerhouse, why did its stock take such a beating in the first place? That's a valid question, and it's exactly what made this moment so interesting for big investors. The drop wasn't about the company falling apart. It was all about fear and misplaced caution. It started with pressure from regulators. The Medicare Advantage industry came under fire, and United Health got caught in the middle. The Department of Justice launched an investigation into whether insurers were inflating patient diagnoses to get bigger payouts from the government, and that stirred trouble. That kind of accusation can rattle investors, especially when it's tied to federal scrutiny. But United Health wasn't blindsided. They've got $17 billion in cash, and they've already put aside funds in case fines come their way. They're cooperating with the investigation, and it's worth noting that other insurers are facing the same questions. Other insurers like Humana and Cigna face similar investigations, showing this is an industry issue, not just United Health's. Then came the cyber attack that began last year, targeting Change Healthcare's claims processing, billing, and patient eligibility systems. Their Change Healthcare unit was hit hard, And it wasn't just a minor breach. It affected nearly 193 million people, making it the biggest healthcare data breach in US history. Payment systems froze, providers scrambled, and the company took a $1.1 billion hit in just one quarter. That kind of disruption doesn't go unnoticed. Investors saw the earnings drop and got nervous, but the company reacted quickly. Most systems are back online, and they're pouring money into cybersecurity to make sure this doesn't happen again. Analysts think the financial damage will fade by 2026, so while the short-term pain was real, the long-term fix is already in motion. On top of all this chaos, something else that's truly shocking happened. Last December, United Healthcare's CEO, Brian Thompson, was murdered in a targeted attack. That kind of tragedy shakes any company, especially one already under pressure. But United Health didn't stall. They brought in a new CEO quickly. And while leadership changes always bring questions, the company's deep bench of experienced executives helped calm the waters. Stability matters, and they showed they could keep moving forward. Still, the market doesn't always react logically. Retail investors started selling fast as the bad news piled up. That panic selling drove the price down, and short interest climbed to 1.69% of the float. That means a lot of traders were betting the stock would keep falling. So while the headlines looked grim, the story underneath was more about temporary shocks than long-term damage. And that's exactly why smart money moved in when others were running away, all while United Health stood firm. That resilience in such dire situations is what separates United Health from many of its peers. It's not just big, it's deeply integrated. Through Optum, it controls pharmacy services, clinics, and data analytics. That means it doesn't just pay for care, it delivers it. Optum Health alone serves over 100 million patients, and its ability to use data to predict needs and reduce costs gives it a competitive edge. In the second quarter, Optum brought in $63.9 billion in revenue, with operating margins at 20.7% after adjusting for one-time costs. That kind of performance isn't common, especially during periods of uncertainty. And then there's Medicare Advantage. United Health is the dominant player, with over 30 million members and a 25% market share. That's not just a number, it's a reflection of trust, scale, and efficiency. As the US population ages, demand for Medicare Advantage plans continues to climb. United Health expects to add another 1 million members in 2026. And with half of all Medicare beneficiaries now enrolled in Advantage plans, the growth runway is long. This isn't a short-term trend. It's a demographic shift that favors companies with reach and reliability. What's also worth noting is how United Health's structure positions it for long-term success. Vertical integration allows it to capture more value from every healthcare dollar. By owning the insurance, the clinics, the pharmacies, and the tech platforms, it reduces waste, improves coordination, and keeps costs in check. Even after absorbing the cyber attack costs, its operating margin held at 8.4%, and analysts expect it to climb back to 9% by 2026. That kind of efficiency is hard to replicate, and they're not standing still. United Health has a history of smart acquisitions, like the $5.4 billion deal for LHC Group, which expanded its home health capabilities. With $17 billion in cash and $10 billion in quarterly free cash flow, it has the flexibility to keep growing, whether through new services, geographic expansion, or strategic buys. That kind of financial strength isn't just a cushion, it's a weapon. So when you look at the full picture, it's not just about a stock that fell and bounced back. It's about a company that took hits, absorbed them, and kept moving forward. It's about investors recognizing that the fundamentals didn't break, even when the headlines did. And it's about a business that's positioned to thrive in a world where healthcare demand is rising, not shrinking. That's why the rally wasn't just a reaction, it was a recalibration. The market had priced in too much fear, and once the dust settled, the real value started to show. For investors who look beyond the noise, United Health offered something rare: a chance to buy a dominant, diversified, and durable business at a discount. And that's the kind of opportunity that doesn't come around often. The rush to buy United Health now isn't just about excitement. It's about timing as well. Markets are shifting. After years of chasing high-growth tech stocks, investors are rotating into safer ground. Tech valuations ballooned, with some names trading at 50 times earnings. That's a steep price for growth that's starting to slow. Meanwhile, United Health is sitting at a much more reasonable 16.45 times earnings, making it look like a bargain in comparison. Interest rate cuts expected later this year or early next year are also changing the mood. Lower rates make borrowing cheaper and improve the outlook for companies that rely on steady cash flow, like insurers. That's why Dow stocks are getting more attention, and United Health, being part of the Dow, benefits from that shift. Passive funds that track the index have to buy it, but the real momentum is coming from active investors, people like Buffett and Tepper, who are making deliberate moves based on what they see ahead. Then there's the short covering. When big funds started buying, it triggered a scramble among short sellers. Those betting the stock would fall. They had to buy back shares to close their positions, which added fuel to the rally. Short interest dropped from 1.69% to under 1% in just a few weeks. That kind of reversal shows how quickly sentiment can flip when the tide turns. Year-end portfolio moves are also part of the story. Big funds want solid names like United Health in their holdings when they report to clients. After a rocky year, they're looking for stability, and United Health offers that. A 3.25% dividend yield, backed by strong cash flows, makes it a reliable pick. The company paid out $8.84 per share in dividends this year, and still has plenty of room to grow, with only 38% of earnings going toward payouts. For everyday investors, this doesn't mean blindly following the big names. They've got teams digging into data and models most people don't have access to. But their reasoning is clear. United Health is undervalued, and its business model works in good times and bad. There are risks, of course. Regulatory scrutiny could lead to fines, but the company has $17 billion in cash to absorb that. Medical costs are rising, with utilization up 3% last quarter, which could pressure margins. And the fallout from the cyber attack isn't fully behind them. There are lawsuits and cleanup costs still in play. But even with those challenges, the long-term picture is hard to ignore. Healthcare isn't going anywhere. People need it, and United Health's scale gives it a huge advantage. Earnings are expected to hit $16 per share in 2025, up from $14.10 in 2024. Revenue is projected to climb to $445 billion. The dividend keeps growing, up 15% annually on average. Oh, and the company's market cap, now around $246 billion, could reach $300 billion in the next few years if growth continues. When investors as different as Buffett, Burry, and the Saudi Public Investment Fund all pile into the same stock, it's not a coincidence. They're seeing something real. A company with strong fundamentals, a fair price, and growth that stretches well into the future. Whether this rally is just getting started or facing more bumps ahead, the setup is compelling. So what does it all mean? It's not about chasing names. It's about recognizing the kind of business that can weather storms and still grow. United Health has taken hits, but it's still standing tall. For investors who believe in buying great companies when they're down, this is one of those moments that's hard to pass up.